Welcome to CIMA Financial Strategy May 2014 revision program. I'm Sugeeth Pathbendige. My task in terms of this particular program would be to look at two different aspects in terms of supporting you to pass your exam F3 this particular time of May 2014, and especially we all know that from 2015 there is a new syllabus change that is going to happen, so this particular May and November would be crucial for students who are used to the old syllabus. Now in my discussion of this program, I'm looking at two different sections. The first section I'm looking at essential questions that one needs to know, and for those essential questions one needs to have particular theoretical understandings as basis if those questions are to be tackled. So I am going to look at some of the essential questions as for the requirements. I'm also going to talk about the theoretical parts and theoretical basis that one needs to have in order to attempt those questions. In the second segment, I'm looking to talk about examination techniques and also particular pre-scene analysis on PPLC pre-scene that we have got for this time, and also looking at bit of expectation or forecasting as for a possible unseen that can happen at your exam. Now let's take a look at firstly the different areas of this syllabus in terms of Unit 1, Unit 2 and Unit 3. Any student who is going to go for the F3 exam this particular time or any other time would know there are three different sections in this syllabus, and very nicely the syllabus is structured around the word called strategy. And we all know the official definition for strategy is to ensure that you achieve a particular stated objective, have the right resources and have the right courses of action. And if you scrutinize that particular definition, you will see there are three parts in terms of strategy definition. You will have to have the right objective, you will have to have the right resources, and you have to take the right courses of action. So if you are going to talk about financial strategy, then your right objective should be financial objective and your resources should be financial resources, and finally whatever the courses of action you are talking should be scrutinized from a financial angle or a viewpoint. So if you look at our unit number 1 in terms of financial strategy, it is about getting that right financial objective and the subsequent angles that one needs to know about. And in the second unit, it is about getting the financial resources, and in terms of financial resources, of course, there are different options, and combine what would happen in terms of cost of capital one needs to know. And then the third one is to ensure that you look at the courses of action available for organization from a financial viewpoint and assess their viability from a financial viewpoint. So any student who is preparing for this particular subject needs to have a real good hold of what these units are and their content prior to obviously attempting the paper. But then there are essential areas that within the time limitation that we have in this program that I'm looking to take you to. Let's start with firstly one question that is likely to happen at your exam. That's what we call financial objective side, as what I've already identified. That's part of unit number 1. Let me pull a question from November 2011, question number 2. Obviously the scenario I'm not putting, but one needs to look at the scenario and then look at the relevant question. The question is asking, advise the directors of T the extent to which the company meets its financial objective both before and after proposed acquisition. So you need to look at the financial objectives and their achievement that needs to be measured, and then appropriateness of the stated financial objective. So how appropriate the financial objective one needs to do the discussion, and to do that obviously a heavy theoretical understanding would be needed. And then normally with these financial objective questions, it is customary bit of treasury management side is talked about, because the financial objective, majority of the objectives, custodian would be the treasury and the treasury function that is there. So let's look at the theoretical understanding that one needs to have in order to attempt the question that you are currently looking at. Now as for theory, number one part that students need to know would be, when it comes to setting a financial objective, you have the option of what we call profit maximizing. But then profit maximizing, the word profit obviously contains non-cash items. One can do a bit of window dressing, and over time profit is something that companies have shown, but then all of a sudden the very companies that had shown huge amounts of profit had collapsed. So the trust for the profit word is also questionable, and on top of that, when people talk about profit, they don't look at time value of money. So theoretically speaking, the right financial objective is supposed to be wealth maximizing. Theoretically speaking, wealth maximizing implies make sure that you look at the cash of whatever the decision and try to maximize the cash situation of that decision. Why? Wealth is an equivalent word for what we call cash. And if you look at wealth maximizing in a much more practical manner, it is all about ensure whatever you do, you undertake positive NPV generating projects. Why? NPV look at cash. So if you are looking to maximize future cash, the best technique where time value of money is also looked at least theoretically, is supposed to be NPV. So shareholder wealth maximization, that is also an important point. Why? When you say wealth maximizing of an organization, organizations would have many stakeholders. Who's the real owner of an organization? Surely shareholders. So the financial objective should be shareholder wealth maximization. That means whatever you undertake positive NPV generating projects, and the viewpoint should be from a shareholder viewpoint. Now, once you know this, one of the other angles that can happen would be, now this is good as an objective for organizations which are profit making. But if you are not for profit making, then talking about making more money does not make sense. Then the options that are there would be what we call non-financial objectives, or more of a quantitative wise, you can look at what we call value for money concept, which talks about three sub-objectives under that: economy, efficiency and effectiveness. Economy part talks about from money the amount of input, and you are looking to measure that. And then in the efficiency part, you are looking at from input the amount of output. In the effectiveness part, you are looking at from output the value. And if you set off input, output of economy, efficiency, effectiveness clubbed together, then of course you get this concept called value for money. But surely if you are not for profit making, it is important a more balanced scorecard approach is undertaken rather than a pure financial side objective set. And then one also needs to understand, if you look at most of the questions, examiner is very shy to use the wording shareholder wealth maximization. Rather, shareholder wealth maximization entails three main functions. One, of course, is the investment function. Other, the financing function. Other, since it is shareholders' wealth, they need to get something of tangible feel that they are getting their wealth maximized. So the dividend part is also important. So shareholder wealth maximization, as what you are seeing with the mind map that I am projecting, clearly you have investment, financing and dividend part, and from those you can have sub-financial objectives given, and you would be then asked to measure their performance. One other thing you need to understand, all of these different angles, particularly the financing part and the dividend part and managing relationships with other parties from a financial angle, is supposed to be the responsibility of Treasury. And Treasury, of course, you can obviously get questions at your exam, and that Treasury question generally will ask what are the roles of the treasurer. Ideal way to remember would be as a pyramid structure: strategic, tactical and operational. Strategic level, of course, or the highest level, treasurer will have to look at what are the different capital options, what are their risks, what are the returns to be paid. When they are combined, what's their overall cost of capital, or what we call WACC. And the tactical situation, of course, treasurer will look at considering the going situation around the company, what would be the particular capital option timing wise, and then who are to partner with in raising that capital, how to price it. For example, if you're going to go for a share issue, at what price, right issue at what discount, those angles are all tactical angles that the treasurer will have to look at. And operationally, of course, how to eventually raise that money, and then that money to be deposited at the right places and to be used at the right times, and then also managing relationships with customers in terms of collecting payment, suppliers in terms of making payments, managing relationships with financial institutes day to day. Those are all what we call operational aspects. Now, beyond this, of course, one also needs to understand, as I've already identified, you might be asked to measure the financial objectives. How do you measure the financial objectives? You will have to look at one option, since the overall theoretically superior financial objective is shareholder wealth maximization. You can look at shareholders' return, dividends, and the capital gain. Since wealth is cash, you can forecast the cash and use that. The other angle would be the ratios. And when you are doing ratios, please make sure that you know the angles of the 5 different types that are there: profitability, liquidity, asset, the gearing one, and the investor ones. Particularly when you are doing the asset ones, you normally multiply it by 365. But be careful, if they give biannual, it should be 365 divided by 2. If they are giving quarter, it should be 365 divided by 4. And there is a high probability, even if you look at PPLC, that since one of their strategic objectives is to deleverage, these ratio angles might come in a big way. And if they give you the financial objectives in detail in unseen, and you might have to look at all the different measurement options and measure those financial objectives. So let's now pause for this particular area, and then after the break we will take up the next area, which would be into the financing part. Welcome back. We have been looking at financial strategy, and the first unit of setting the financial objectives and related matters in a very concise manner we have looked at. And as I mentioned in the previous session, that it is crucial that students know the theoretical angles that are there and obviously blend with a given scenario and then come up with the answers as required from you. Now, going into another part which is partly related into the unit number 1 and partly related to unit number 2. Unit number 1, it's about getting those financial objectives and setting those financial objectives, then eventually measuring those objectives contain those ratio analysis as what I've already recognized. Now, when you do those ratios, of course, you might also identify not only about those financial objectives, but also a possibility of company being overtraded. And that overtrading angle you would have firstly learned in CIMA in P1, but in overtrading it is all about certain organizations doing too many things too fast with too little proper capital. So if you can identify revenue is fast increasing but cost is increasing faster, and the current ratios are getting worse, and then even asset ratios and particularly working capital cycle is becoming bulkier, gearing is increasing, dependence on OD is increasing, all those angles will tell you overtrading. Now, if you look at the pre-scene that you have got for May of 2014 and also the September repeaters online paper, if you do an analysis and check with the industry, particularly there is a company called Woolsey PLC which is very similar and most probably PPLC pre-scene is modeled on that company, and when you compare with that company as well as industry, you will realize that PPLC, some of the ratios tad bit overtrading is indicated. Particularly if you look at the current ratio, not that great, profitability not that great comparatively, right? And all of that then tells you there are certain symptoms of overtrading with PLC. So candidates need to ensure that they are prepared to tackle an overtrading situation, and if there is overtrading, the question would be firstly how do you recognize it? So the symptoms needs to be known, and then how do you create solutions for it? Obviously you will have to restructure the business, particularly focus on core, maybe divest the non-core, and then capital structure also needs to be restructured so that some of your short short-term ODE, unnecessary dependence, is converted to long-term. Some of the long-term debt is converted to more of equity, so unnecessary pressure is not there. And also certain working capital components such as receivables, payables, as well as inventory needs to be better managed. So the overtrading angle one needs to know, and beyond that, of course, you can also get a pure working capital angle being tested, most probably in a 25-mark question situation. Let me read to you a question like that. Say May 2010 question number 2. That's a classic working capital question. Calculate the short-term and long-term financing requirements of PIC under aggressive policy for financing net current assets that is currently being used, and also under proposed new conservative policy. So one needs to know how to calculate the permanent working capital as well as the temporary working capital, and then connect that into how it is funded and figure out aggressive and conservative policies. Calculate the implied issue price of a 100 nominal bond being considered by treasurer. Now, how do you get an implied price? That actually comes from your brought forward knowledge of P1. You should look at this bond, what are the coupon rate or annual interest rates you are looking to pay rather, and then in terms of maturity, what's the redemption value, and then look at the overall earning of the bond that you are projecting, what we call YTM, yield to maturity, and discount using that rate, you would have got the present value. But generally in FS we wouldn't teach that particularly, but you need to have that brought forward knowledge. And then calculate weighted average cost of capital, we'll get to that later on, and then propose change aggressive to conservative, they want us to evaluate that, and then alternative approaches of financing net current assets, also they are asking what we call working capital. So if you look at this question, it was a 25-mark question and predominantly it's working capital, although there are a few other angles. Now what is it that you will have to know in terms of working capital? You will have to know that working capital management is ensuring that you keep your liquidity, at the same time you go for highest possible profitability, or in another wording, you do not have too lesser current assets, not too much of current assets, have the adequate amount so day-to-day operations can be done. To do working capital management, of course, one needs to firstly know the requirement. That's what we call investment decision. How do you recognize the requirement? You can look at a lot of factors, but from a calculation angle, once you know the different working capital components of receivable, inventory and payable, and over time those should fluctuate, firstly recognize their maximum values that are likely and minimum values that are likely. And then how do you identify the permanent day-to-day working capital needed? And then we know New Year or Christmas, more sales should be there, so more working capital would be needed. So those times there will be temporary requirements, but before that, permanent requirement you need to identify. Permanent requirement is also supposed to be similar to that of the right working capital management situation, the best time you are managing your working capital. That means your current assets are at the lowest, and of course your current liability, particularly payable, would be at the highest. Why? If you are managing your working capital better, that means you are not stuck with monetary issues in terms of day-to-day operations. So your receivable and inventory amount, where your money is generally stuck, is at lowest. Payables are highest. Why? You are delaying payments to your suppliers. Obviously that might harm the relationships, and that would be a different connotation to talk about, but true enough, you have to understand that in terms of getting the permanent working capital identified, it would be current asset of minimum figures, receivable and inventory, and the payable figure, take the highest, you would get the minimum working capital. Minimum means permanently minimally needed. So that's how you get the permanent one. And how do you get the temporary one? That would be the highest time of requirement. So that means you have to firstly calculate the maximum working capital. How do you calculate the maximum working capital? Surely the worst possible time also is this, where money is stuck in receivables, money is stuck in inventory. So take the highest or maximum receivable and inventory, but then you are too frequently paying to your suppliers, that would be the worst time. So you take the payable minimum figure, take the net, and that would be maximum, and maximum would be the highest needed. Difference between the maximum and minimum would be what we call temporary. So you need to know how to calculate, because this question straight up was asking you to calculate. And if you look at the mind map that I have projected, clearly that calculation is also there. And beyond that, of course, once you know your permanent and your temporary ones, you will have to then look at how do you actually get that funding done. And if the permanent sources are funded from long-term sources of capital and the temporary ones are funded through short-term, then of course it's a moderate balance situation. But if there is more of short-term use, it is an aggressive policy, and more of long-term use, then it's a conservative one. You will have to blend to the scenario, look at the circumstances, see whether the company's risk-return trade-off or profile is conducive to a particular policy, and based on that, make the recommendations if it is asked from you. So that's the working capital angle. We will wind down the session for this part as at now, and beyond this we will take a small break and come back and look at more of financing decision parts. Thank you. Welcome back. Let's now look at long-term financing angle, because in the previous segment we were looking at the short-term funding, particularly working capital angle. In terms of long-term funding, of course, we have equity funding option, we have debt funding option, and then we also have purchase versus lease story, particularly that would be lease option. Let's firstly talk about the equity option that is there, and for that purpose you might get questions of going for IPOs and initial public offer, maybe going for secondary public offers, which is a company which is already in the stock market, or you might get a more probable question, considering this particular diet, you might also get what we call right issue angle. Now firstly, if you are going to go for an IPO, one needs to know there are different types of IPOs that one can do. One of those IPOs is what we call offer for sale or issue via an issue in house. And offer for sale or issuing via an issue in house simply indicates if I am a particular company looking to issue shares via an IPO, rather than me undertaking that issue, I will transfer those shares to an investment bank. Investment bank will do all the needed documentation, guaranteeing to the relevant stock market, even underwriting, and then they would make the offer to the general public. That's what we call via an issue in house or offer for sale. And in UK, that's more than likely the situation. So you look at the circumstance and then based on that try to interpret the particular type of IPO, and when the issue is done, they might make the issue on a fixed price or they might make the issue on a tendering situation. But there is also another type of issue, what we call prospectus issues, where the company will directly invite the public to subscribe for shares, but obviously support services would be taken from investment banks in terms of modeling the issue. In addition to that, brokers would be involved. In addition to that, corporate secretarial practices would be involved in terms of getting the documentation done. And also another option is to go for what we call placements or private placements, where you hit on large institutional investors or large equity investors that are there, and then those parties would subscribe in large parcels as such. If you look at the PPLC pre-scene situation and you look at the related industry, there are a lot of different share issues in the past that had happened which had not been for general public but for placement. You can use that as a point in terms of justifying certain recommendations you are going to make if that situation arises. Now beyond this, of course, one also needs to understand that more than likely, in my viewpoint, in terms of May of 2014 is a right issue, because they have not tested it for a while in comprehensive fashion. If you look at a right issue, let's take a question, November 2011, question number 3. Obviously it contains a bigger scenario and one needs to practice after reading the scenario, but the questions are asking terms of the right issue. That means, so how many shares, how many rights you are looking to issue at a discount of both 25% and 40%. So most of the CIMA questions work on this contentious issue of what discount that you need to set the right issue. So you attract people, but at the same time you don't issue too many shares which should have unnecessary EPS dilutions as well as pressure on dividend. And yield adjusted theoretical ex-right price, one needs to know that's a weighted average calculation based on whatever the cum right price that was there and the issue price and the total new shares that are there taken as a denominator, and then demonstrate the likely impact of the proposed project together with the related right issues on the wealth of the shareholder with 100 ordinary shares. That's where you are asked to discuss about anyone who is getting the entitlement for right issue, if they have subscribed, what would be the situation? If they are not subscribing, what would be the situation, or what are the alternative options that are available to them? And then recommend appropriate discount, if any, for right issue, which is more or less what I've already talked about under A1, and advise directors of DCD on factors that are likely to affect the company's share price both before and after next month planned press statement. Particularly efficient market hypothesis angle are applicable in terms of, or is applicable rather, in terms of question number D. Now, if you are looking at the related theoretical understanding one needs to have, just prior to the right issue, the share price is called cum right, because that particular share will have the entitlement for the right issue. And then when you are doing the right issue, you have to come up with the right discount. CIMA has this connotation that it should be at least 20%. If not, it's not good enough to attract people. But it depends from a UK perspective, any other perspective. But rather, a better way of deciding what would be the best discount would be to look at the intrinsic value of what you're trying to do here and the extrinsic value of what you're trying to do. What am I talking from intrinsic and extrinsic? If you are going to do a right issue at a very deep discounted situation, to raise the capital you need, you will issue too many shares. Then what would happen? The inner value of a share is its earnings capacity. Earnings per share, that will get diluted. That angle needs to be looked at. And then if you also issue too many shares, and if you give the wrong message, people might not take up the right issue, and that might lead to further selling over the existing shares, and the market price will get suffered. That angle also needs to be looked at. That's what I mention as extrinsic situation. So both looked at, as well as keep in mind that at least at 20% to attract, you need to work on the decision making. And as for the PPLC pre-scene, some of the analysis that I have done indicates in that industry, some of the right issues, the discount had been 38.5%. So much more than the normal expected 20%. So you might have to say, in this industry, if by any chance the right issue angle appears, that the discount needs to be a bit more obviously than what is normally agreed and accepted. And then once you have the right issue price, that and how many right issue shares you are looking at, and then also look at what was the cum right price and the number of shares that gave the entitlement, and get their weighted average calculated. That is what we call theoretical ex-right price. And anyone who's not having those right entitlement might want to buy the entitlement from somebody who's having the entitlement, and then what price that somebody should pay is what we call value of the right. So the difference between the TERP and the issue price is what we call value of the right. You can see it from the mind map that I have projected. Now the other angle that one needs to know would be that if you are a right hold and you are told you have this much of rights, what are you going to do? You can fully subscribe, and if that happens, of course, you will have more shares, but at TERP after the right issue, but you will have to pocket out certain money at issue price to buy it. So look at the net wealth, compare from where you were to now, decide whether to take it up or not. And then the other side, you are not going to take it up. Please make sure you remember that then company would have the entitlement to seize it from you because you have not taken up the right, and then subsequently find possible buyers, and most probably at TERP, and by any chance if there is excess money than what they wanted from the issue, that should be theoretically speaking returned back to the original right holders. Beyond that, one other angle that can happen would be that if you want to buy the rights but you don't have the money, you can obviously try to sell some of the rights and buy at least some of the other remaining rights. For that purpose, of course, simply assume the rights that you are going to sell is equal to X, and then look at a small equation. If you sell, to buy how much, and put a equal sign and get a small solution done so that you will identify how many you are going to sell and how many you are going to buy. Now, as for the right issue angle, that's all that I wanted to talk about within the time that is available. But please make sure that you know about the equity issue angle. Please make sure you know particularly right issue all the angles. Hopefully, the question that I have demonstrated, you will start with that, and there are about at least 2 more questions with great detail when it comes to the right issue angle and also the IPO angle, and even how to make an IPO successful. Those factors needs to be known. Thank you. Welcome back. We are into another segment. Previous segment or session, we were talking about the initial equity financing angles. But when it comes to equity, it is also crucial not only that you get people to subscribe as shareholders, but also you retain people. If not, they will start selling shares and there would be a hit on the market cap or market capitalization. That obviously BOD in an unnecessary manner will have to tackle as well as address. So protecting the share price involves understanding the fact that right dividend amounts needs to be given as well as the right kind of information needs to be put out to the market. So what kind of question that you can get from that area? Let's look at equity return side. That would be dividend and the capital gain side, particularly share price movement side. May of 2011, question number 2. Evaluate the current dividend policy. So value of the dividend policy via calculation, via theory connected to scenario. That's what that action verb talks about. And if you look at current dividend policy, if you are going to evaluate, you need to know the theoretical understanding of different dividend policies that are there, and also what kind of clientele effect requirements that are there. What we mean by clientele effect would be that similar birds would flock to certain companies kind of mentality, meaning that we do have this understanding the shareholders of a particular company have particular expectations, and those expectations needs to be identified and those needs to be catered via dividend policy as well as the information being furnished and even the actions the company is taking. That's what we call clientele effect. So clientele here, the clients would be shareholders that we are referring to. And then describe the process involved in IPO. You will remember I was talking about different types of IPOs that one can do, but when you read the scenario, they are telling via issue in house, so offer for sale. So you should have only described that type, and then advise the potential risk involved in an IPO. One obviously is that under subscription happen, and then you can have underwriters, but obviously commission can hover from 2 going up to even a maximum of 5 to 6%. So that angle needs to be looked at. Even the other side, even oversubscription can be seen as a risk. Why? If it is oversubscribed, that indicates that the discount was bit more than what was anticipated by the potential shareholders. So that would mean that the shareholders would have taken up the issue with a lot of eagerness, but that also means that it was cheap. And if it was cheap to shareholders, of course, company or the potential investors, then the company have not raised the capital that they could have raised and what they can raise in future. So that angle also needs to be looked at, and then discuss the concern of directors regarding possible implications of becoming a listed company, particularly the exposure that you get in terms of regulations that are there that you need to be complying on, and then you also need to understand all your actions would be scrutinized by the shareholders. But please do keep in mind when you're talking about stock market, you can have 3 different types of stock markets. One would be the larger one, London Stock Exchange for example, and those parties obviously the regulation requirements would be much higher if you're quoted there. More of a mid-market one where the regulation set is lesser is what we call alternative investment market. When the regulations are lesser, the risk side is also higher, and those shareholders who are normally operating in AIM are not supposed to be particular about dividend, but they're looking at capital gain side. And then there are off markets where people or the sellers of shares and the buyers would get together temporarily and do the transactions. So please do keep in mind any discussion would also also depend on, in the scenario, what kind of stock market quoting and the level of stock market quoting that they're talking about. Now, let's quickly look at the theoretical background behind the dividend side. Dividend side, of course, there are different possible policies. There are obviously relevant theories also. But please make sure whatever the policies or relevant theories of those policies that you're going to talk about, you look at what I had already mentioned called clientele effect. By any chance, you are looking at alternative investment market. I've already identified they are unlikely to be particular about dividend, but they are more than likely to be particular about the capital gain side. And then prior to even getting listed, if you're a private company, most probably family members are heavily involved in terms of day-to-day businessing, so they don't need any signals as to where the company is going, but they would need a constant payout because they would most probably depend on that earning in terms of organization that they are working, as well as they are owners. And then if you're also looking at a company which is quoted in the larger main stock markets like London Stock Exchange, then of course you are looking at a situation where majority of your shareholders can be institutional investors, and institutional investors, of course, they have their own payments to be done. For example, if it is a pension fund or an insurance fund, they have their own payments. So if they are to do their payments, they would need regular payments from your side. That means regular dividends might be expected. In addition to that, of course, these particular institutional investors might also contributed to this company or subscribe with a particular agreement with the company on certain dividend policies. So those angles also needs to be looked at. But when it comes to the theories that are there, residual theory simply says that you should only pay dividend if you do not have good investment opportunities. Traditional theory generally argues if more dividends are paid, normally shareholders like. So the theory argues on paying more and more dividend. And then Modigilani and Miller talks about dividend irrelevancy. Their argument is when dividends are paid, there is a cash leak, and that means the value of the company will come down. So if I'm a shareholder, what would now happen is my share price will come down equivalent to that dividend amount paid. So when I have my dividend payment in my pocket, although I have a dividend payment, share value had come down, nullifying the dividends gain via capital loss in the share price. You can take some figures obviously and prove it in a much more bigger manner. But M&M theories are so crucial. You will know, considering M&M capital structure theories that are there. But M&M theories are generally based on number of assumptions. One, perfect capital markets, which talks about there are no transaction costs, there are no tax discrimination, and there is what we call symmetric information. And then if you look at rational investors, the argument is investors are not biased towards dividend or capital gains. They will look at the situation and rationally make decisions, and perfect certainty that all the shareholders and players have about the company's future. Most of those assumptions are irrelevant. One can call a dividend irrelevancy theory itself is irrelevant, but there are angles of importance, particularly that companies should understand. If their performance is not good, you cannot just pay dividends and fool people, because people are looking at the value of the company based on what the company can earn in future, and not just based on the dividend being distributed. And then one also needs to understand share price movement. There are theories. One of those theories is what we call fundamental theory, which fundamentally argues value of a share price depends on its future earnings capacity discounted at an appropriate rate, which makes a lot of sense. And then there is also what we see in newspapers frequently of charting or technical analysis, where past different price movements are put into a chart and a worm showing next month what would happen. Like in our stock market, where people are talking September things would be much better than normal months, but then what's the rationale behind it, and can you just wait for that particular month to happen, is obviously going to be questionable. And then the other very important theory is what we call efficient market hypothesis. A lot of students don't really understand this. What efficient market hypothesis simply means is, if there is a market that you make new information available, and then in that market the relevant share price will quickly change, such a market is assumed to be efficient market hypothesis. So in an efficient market, when you make new information available, the share prices would quickly, rapidly, readily, in full are supposed to move. But you have to understand, depending on the speed of movement, there can be three types of markets. One what we call weak, it will take time. Other is what we call strong, which even the boardroom discussions will get transpired into share price movement very quickly, and we all know insider dealings are not allowed in terms of trading in almost all the countries that we know of. And then normal developed markets are supposed to be semi-strong. The price is supposed to represent whatever past publicly available information. And what do we mean by public? Those are what we call speculative information, where the shareholders speculate certain things, and based on that the price movement will behave. But then you speculate something, but if a shock happens out of latest information, shareholders are likely to adversely react. So companies need to look at what is it that their shareholders had speculated, feed them, rather than trying to obviously do extreme angles that will go contradictory to that of speculated angles. Now, quickly looking at another angle that students need to know, but this time not very sure to what extent it can be tested, particularly considering that last online repeaters paper had this angle appearing, and even November of 2013 we had certain questions appearing from this, not November but May 2013. If you look at purchase versus lease, I have extracted this May 2011 question number 3.1, where you need to compare if you purchase, if you lease, and then on NPV terms decide what's the best option. That would be lowest negative NPV given situation. How do you do this calculation? Of course, the mind map that I am projecting to you will come in handy, where you need to understand if you are purchasing, whatever the purchase price as well as scrap value would be relevant, and then if you are purchasing, the capital allowances and the tax benefits of those are relevant, and of course you should discount it at the cost of debt rate, because we are assuming that purchasing funding would have come via debt, and that particular cost of debt rate should be for the effective situation, so 1 minus T should have been applied. And then if you look at the finance lease or whether it is operating lease, firstly let's talk about finance lease. It's crucial that you understand the installments needs to be taken, but if you take a lease, then the ownership is not the lessees, it would be lessors. So capital allowance would not be available for lessee, but lessee would get different tax benefits. One would be whatever implied interest, that would be tax deductible. Normal accounting depreciation, which is not allowed for tax depreciation, is also allowed. So you need to identify the normal accounting depreciation and take T of that. That could be a tax benefit. And implied interest rate, that's a tricky one. You have to calculate that. In the past they've tested it number of times. One option is to look at what we call the actuarial method. The actuarial method, of course, involves using the IRR methodology to identify the implied interest rate, and of course apply that implied interest rate to the opening balances of each of the years and identify that implied interest rate. Why we call it implied is that they had not given to you that rate straight away, so you are implying and you are calculating. The other option is what we call sum of the digit method, which is not very logical but very mechanistic, but would do the trick very fast, where you can take the number of years, their digits, add it, identify the total interest, divide by the total digit number, and then go on the reversal digit number in identifying what are the implied interest, because in a lease agreement, initial installments, anyway we all know the interest component is higher, and that diminishes with the number of installments you are paying. And then once you have all of this, you will have to discount the cash flows, and you are going to discount it again at the same rate as what you had done for the purchase part or purchase decision. That would be KD 1 minus T. Why KD 1 minus T? The argument is lease is seen as a very close substitute of debt-based purchasing. Since the opportunity of lease is debt-based purchasing, and that opportunity is having a cost of capital, opportunity's cost of capital is taken to evaluate the lease situation. But if it is an operating lease, of course, the calculations are generally very easy, and you will take the installment, you will take all the installments as a recurring expenditure, that means fully tax deductible. So you will take the tax saving and again would discount at the same rate as what you had taken under purchase, and you can compare. But you need to understand that when you are doing this comparison, certain very important points can appear. For example, you might be told that the tax is paid in the year, or maybe half this year, half next year, as quarterly self-assessment rules goes, or maybe 1 year in arrears. So you look at the timing and put it at the right place. When you are making the installments also, you might be told in arrears. That would mean if you are looking at a particular year, that's at the end of the year after consuming the service, or in advance, that would be at the beginning of the year. So look at the right timing and club it. And also you might be told maintenance cost. If by any chance whatever the different options, purchase or finance lease or operating lease, all three anyway maintenance cost is there, no point taking. But if one is containing those inside the cash flows, others are not having, you need to bring in the maintenance cost, and maintenance cost is obviously going to be tax deductible, so that angle also needs to be looked at. So we have now talked about the equity angle. We have also talked about the lease angle. One angle we did not talk about would be the debt angle. But in terms of debt capital, of course, you need to understand you can go for bond issues, and bond issues are generally secured ones that are there, and unsecured ones are what we normally technically call debentures. And then if it is a bond or a debenture that you're going to go for, one needs to obviously calculate their cost and decide whether that's the best option, or lease the best option, or whether it's the equity the best option. So we come to the end of our first part of the FS revision, and in our second part, of course, we will start looking at very quickly about the cost of capital calculations. Mostly calculations are there, but then obviously you need to have the theoretical underpinning also, and then the valuation side, a crucial part. And also at the very end we will also talk about the examination techniques and examination preparation, as well as the pre-scene analysis. Thank you.